If your crypto project isn't CARF compliant by 2026, you could be locked out of 50+ markets. This isn't about securities, it's about taxes. The new OECD's crypto asset reporting framework is now going live, and founders are massively underestimating it. If you touch swaps, stablecoins, DAOs, or wallets, this applies to you. Now let's break it down. I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. Today, we're diving into OECD's Crypto Asset Reporting Framework, or CARF for short. And I know it's a mouthful. We're going to look at what it means for crypto builders and investors worldwide. Okay, so here's what we'll cover. What CARF is, who it applies to, what must be reported, common blind spots that can get you shut down, and what founders need to be thinking about right now. So what is CARF? CARF is the OECD's crypto tax framework signed by over 50 countries, from France to Singapore to the Cayman Islands. But notably, the United States has not signed on to the framework. It forces crypto platforms to report user transactions just like banks do today. Unlike MiCA or the Genius Act, this is not about licensing. It's about automated tax reporting across borders. And if you're a crypto asset service provider, you're likely within scope. So who must report? Any platform, centralized or decentralized, that facilitates crypto exchange activity for customers must report. This includes centralized exchanges, DEX protocols like automated market makers, wallets with swap functions, payment processors, or checkout providers. And here's the kicker. Even if you're non-custodial or incorporated offshore, you are still subject to CARF if you serve customers in CARF countries. If your dev team is based in one of these countries, and if you operate a branch or front end in one of those countries. So what must be reported? CARF breaks into three major buckets. Exchange transactions. So crypto to fiat, wrapping and unwrapping, liquid staking, they all must be logged and reported. Next bucket, retail payments over $50,000 equivalent per year. So if a user spends more than $50,000 in crypto for goods or services, you must file special reports on that. Transfers of relevant assets, crypto loans, bridge transfers, collateral movements all count, especially if they cross platforms or wallets. Now let's think about strategic blind spots here. Many builders may think they're safe because they're decentralized or don't serve retail. But here's what they miss. Non-custodial does not mean you're exempt. DAOs, or decentralized autonomous organizations, are not off the grid or out of scope. And offshore entities are not actually shielded from these rules. If your platform enables swaps or payments and you touch a CARF country, you could be on the hook here. CARF is about economic substance, not technical structure. So what should a founder do? You need to map where you have a tax nexus, not just where you're incorporated. You need to assess if your protocol enables these exchange functions, and you will likely need to collect data, such as taxpayer identification numbers, addresses, birth dates, etc. This also raises other issues such as GDPR. You need to monitor $50,000 equivalent or more in crypto payments, and you'll need to make sure your systems play nicely with FATF and MiCA compliance. Okay, so let's recap. CARF is here. 50+ countries are rolling out crypto tax exchange as you watch this video right now. It applies to swaps, payments, loans, staking, and more. And if you ignore it, your project may be blocked by partners, banks, or entire jurisdictions. Take a look at the link below where I've included the document that shows the countries that have signed on to CARF. Join me on the path to decoding law, technology, and innovation to grow your business. Make sure to like, share, subscribe, and hit that notification bell. Until next time.